Hello everyone, so this is the topic all about the convertible securities. And in this topic, we will describe the convertible securities, the features of convertible preferred stock, and the features of convertible bonds value. In this discussion, we will know about the calculation also of the common stocks and bonds in converting the securities. So, the convertible securities.
I am Jimar Indawa. This is my report. My report is all about defining convertible securities. Convertible securities is an investment that can be changed into another form. Convertible securities also, convertible preferred stock and bonds are two most common. Convertible securities are convertible bonds or preferred stock that pay regular interest and can be converted into shares of common stock. Converted securities is a financial instrument whose holder has the right to convert it into another security of understanding convertible preferred stock. It gives to the shareholders a fixed dividend and a claim on assets if the company liquidates. In exchange, preferred shareholders don't have voting rights like common shareholders do. Corporations use convertible preferred stock to raise capital. They are especially favored by early stage companies as a financing medium. I have a example about uh, advantage and disadvantage of convertible securities. Advantages to the corporation of convertible securities is lower interest rate paid than on-street bond, maybe the only means for small corporations to gain access to the bond market, and attractive to a corporation that believe its stock is currently undervalued. And the disadvantage to the corporation is average size of convertible offering is very small, and accounting consideration regarding convertible potential dilution of EPS. And we go to understanding convertible preferred stock and the advantage and disadvantage. Advantages of preferred stock. Convertible preferred stock enjoys preferential right over equity shares. Second is issuance of convertible shares can help the company to raise capital. And the disadvantage is also is convertible preferred stock bear higher risk in the event of default as they will be paid only after repayment of principal and interest to bondholders. Second is each shareholder is entitled.
Good day, I am Jetlan Tayona and this is my report. Convertible preferred stock terms. Par value, conversion price, conversion premium, and conversion ratio. Convertible preferred stock terms. First, it is conversion price, the price at which a convertible preferred share can be converted into common shares. Conversion price can be calculated by dividing a convertible preferred stock par value by stipulated conversion ratio. Ibig sabihin, ang conversion price, it can be converted by a common shares and It can be calculated by dividing a convertible preferred stock to a by a stipulated conversion ratio. Pwede rin ito ma-convert sa common shares. Conversion premium. The dollar amount by which the market price of the convertible preferred stock exceeds the current market value of the common shares into which it may be converted may also be expressed as a percentage of the convertible preferred stock's market price. Ito naman sa conversion premium stock terms, ibig sabihin dito ay sa current na market value, it can be shares which is be converted. Pwede rin ito ma-convert. Next is conversion ratio. Conversion ratio, the number that common shares. Ang ibig sabihin po nito ay ma-convert ito sa mga kaparehong shares nito. At that's all po. Thank you.
I am Zaria May Gonzalez, and my topic will be on how to calculate the value of preferred stock. So, calculating the price for a startup preferred stock is often difficult as the business is new, without a track record of sales or other financial indicators of success. So, here's an easy formula for calculating the value of preferred stock. So, cost of preferred stock is equal to preferred stock dividend divided by preferred stock price. Unlike bonds, preferred stock dividend payments are not deductible. So, however, the cost of preferred stock still might differ from stockholders' expected rate of return if the issuer incurs flotation cost. So here's an example. A startup has preferred stock that has an annual dividend of $3. So if the current stock price is $25, what is the cost of preferred stock? So the cost of preferred stock is equal to 3 annual dividend 3 divided by the preferred stock price 25 is equal to 12%. So another is how to calculate the par value of preferred stock. So par value of one share of preferred stock equals the amount upon which the dividend is calculated. In other words, par value is the face value of one share of stock. So here's the formula. So preferred stock par value is equal to number of preferred shares issued multiplied by par value per share. So example is, considered a company is issuing a 7% preferred stock at a 1,000 par value. So 7% multiplied by 1,000, in return, the investor would receive a $70 annual dividend for as long as the preferred stock is outstanding. So a startup reports the par value of common stock and preferred stock on a balance sheet separately. That's all. Thank you. I am Christiana Doris Turla, and I will discuss to you the featured terms in convertible bonds and on how to calculate the convertible securities of stocks and bonds. So, these are the terms that we need to understand in order to get its every conversion of stock and bonds. First is the conversion value. So this refers to the current market value of ordinary shares into which a bond is to be converted. So the conversion value, as with the types of investments such as stocks, options, a key objective with the convertible security is to hold onto it until the market price is higher than the conversion value, thus generating profits through the conversion and later sale of the common stock received. So the conversion value is closely related to the market conversion price of parity value, which are used to identify the break-even values at the particular stock price. Another one is that the conversion value is calculates what the net value would be to the conversion done right as the current market prices in stock. So in understanding what the floor value is, convertible bonds can help bondholder determine when the underlying asset is worth converting. So this includes knowing the face value for the bond. So for instance, or typically, when a convertible bond reaches the maturity, the holder gets the face value principal payment that is equal to the amount they initially paid for the bond. So the bond has also been generating interest over the course of the maturity period. So the second is the conversion ratio. It is the number of common shares received at the time of conversion for each convertible securities, so such as the convertible bond. So to determine the conversion ratio, we divide the par value of the convertible by the conversion price. So the result is the number of shares the holder will receive. The convertible bonds are issued with a conversion ratio, which is the number of common shares the investor will receive if the issuer chooses to exercise the conversion option. So for example, that a single bond with a conversion ratio of 10:1. So it can be converted into 10 shares of stock. And the third one is the conversion premium. It is the premium the bondholder will have over the conversion value. A convertible securities that is trading at a price above its conversion value is said to be a conversion premium. So this makes the security valuable and desirable. A convertible security is considered busted when it is trading at a price for below its conversion value. If the price of underlying security falls too far below the conversion value, the convertible security is said to be reached its floor. A conversion premium is an amount by which the price of convertible security exceeds the current market value of the common stock into which it may be converted, or the excess of the amount at which a convertible security may be sold over its conversion price, or it's known a conversion premium. And the last is the conversion price. So the par value of convertible bond or per share of common stock is called the conversion price. The conversion price is the price per share at which a convertible security such as corporate bonds or the preferred shares can be converted into the common, and then calculate the examples here in converting the bonds and stocks. So the first one is the conversion ratio. The conversion ratio is the number of common shares received at the time of conversion for each convertible security, so such as the convertible bond. So, convertible debt is a debt hybrid product with an embedded option that allows the holder to convert the debt into equity in the future. So, the formula is the number of common shares is to divide to the number of bonds. So, the term conversion value refers to the financial worth of the securities obtained by exchanging a convertible security for its underlying assets. So the conversion value is calculated by multiplying the common stock price by the conversion ratio. So the formula is conversion ratio times the current share price. And the next one is the conversion premium. So a conversion premium is an amount by which the price of a convertible security exceeds the current market value of the common stock into which it may be converted. So the formula is current bond price minus the maximum and the parenthesis of CV multiplied by BV. So where CV stands for conversion value and BV stands for band value without the conversion feature and the value of straight band. So a convertible bond is a type of fixed income security sold by the public companies that can be converted into the common shares of issuing company stock. So convertible bonds work just like ordinary corporate bonds. So paying interest according to the specified coupon rate until you or the company decides to trigger a conversion to equity. So, how do convertible bonds work? So, the convertible bonds are the hybrid securities that offer investors the best of both stocks and bonds. So, like any other kind of bond, they provide a guaranteed income stream and pay back the amount you originally lent the company. So, meanwhile, that the conversion option means you or the company can choose instead to turn your bond into shares of its stock. So, which can offer you great upside potential. Here's where it gets interesting is that the issuing company or the bondholder has the option to convert the bond into shares of stock. So, the convertible bonds are issued with a conversion ratio. So, which is the number of common shares the investor will receive if the issuer chooses to exercise the conversion option. So, when and why do convertible bonds convert? So, when a company issues a convertible bond, its stock price is typically lower than the conversion price. So that means the bondholder benefits more from the stream of interest income from the interest payment. But when the market price of the company's stock exceeds the conversion price, the option to convert the bond into common stock becomes attractive. So, when can convertible bonds be converted? So, the transformation of convertible bonds into shares of stock is usually done at the discretion of bondholders. So, when a company exercises a right to redeem or call a convertible bond, it can force the conversion of convertible bonds to stocks. So here's the examples. Okay, so this is the computation of the conversion ratio. So the conversion ratio can be calculated using the following formula, which is the conversion ratio is equal to the number of shares of common stock over the number of bonds. So for example, if a 1,000 par value band can be converted to 20 shares of common stock. The conversion ratio is 20. Why is it? Because the par value of the convertible band per share of common stock is called the conversion price is equals to 50 is 1,000 divided by 20 is equals to 50. So that is the conversion price. Then you can able to see the results of the conversion ratio by dividing the number of shares of common stock divided by the number of bonds. Another example is the technology company issued 100 million in convertible bonds on the 1st January 2001 with a maturity date of 31 December 2005. So the last date of conversion is 31 December in 2000. So the bonds have 1,000 par value. Take note that we have the par value of 1,000 and coupon rate of 6% compounded semi-annually. So the three bonds can be converted. We have 3 bonds that is converted into 50 shares of common stock. So the current market interest rate is 5%. So it is January 1 of 2008 and the bonds currently trade at 1,325 when the current share price of the stock is 75.50 per share. So we have a given straight bond value 1,000 65.28. Then we should find out the band's conversion ratio, conversion price, the conversion value, and the conversion premium. So this is the solution. Our conversion ratio to be followed by our formula is 50 divided by 3 is equals to 16.67, and the conversion price is 1000 divided by 16.67, which is the formula of the conversion price is common stock is divided by 2, the conversion ratio is equals to 60. And then the conversion value is 16.67, which is conversion ratio multiplied to the 75.50 is equals to 1258.58. So the conversion premium is equals to 1325 minus 1258.58 is equals to 66.42. So that is the solution of our problem.